why don't you enlighten us on what is an opportunity zone?
Yeah, so I mean, using your analogy behind the curtain, that's a good one.
Did you think that was going to play that song?
Yeah, that's exactly what I would pick by going up to bat,
Yeah.
for sure. I mean,
Yeah.
you always wonder about like what they are thinking when they
Sure.
choose that song. But yeah, definitely joking. But so yeah, opportunity zones I think are relatively new legislation, but has been around since December 22nd, 2017.
That long.
It's been that long, but it's been with the IRS and different regulations and rollouts on clarifications. So as of, I would say maybe 2-3 months ago, it's just finally become more clear as to the direction and the really that impetus or that the reason behind the opportunity zone legislation. But it's been created with EIG, the Economic Innovation Group, for some time, and it's on the Distressed Neighborhoods Index. So it's based on census tracts that were from 2012 to 2016. So now we're in 2019 and coming to the later half of that year, a lot has changed since those census tracts have been measured.
So do you feel like you're kind of hitting a moving target or trying to hit a moving target?
I think, it comes back to that opportunity, not to overuse the word, but, the census tracts are antiquated in that sense of, which is the beauty of real estate and
Right.
investing in general.
Real estate in itself is antiquated.
Right, and fragmented markets and having that knowledge base and understanding information where others don't. But, coming back to the legislation, the governors of each state had up to 25% of their state to designate as opportunity zones.
Wow. A fourth of every state.
Exactly. And then 5% of that 25% doesn't have to be low income. It just has to be adjacent to. So there's a lot of flexibility within the governors to designate already emerging communities.
But we know most governors and politicians are not real estate people or business people. So how the hell are they the ones deeming this Oz?
I mean, they're politicians.
Yeah, right.
So
is that even a title? I don't even know.
I think they'll create it, right? If there's some sort of
there's someone smart telling them what to do
right.
with money.
Absolutely. No, but they had the discretion, and you're right. They're not business. They're not real estate people. But if they were to listen to the communities and have that pulse in their communities,
Sure.
they can understand which communities need it the most and which other communities just need that additional spark.
So define for me what an opportunity zone actually is. So, real estate people, everything's an opportunity, right? Everyone's optimistic, right?
Right.
What is actually the legal definition of an opportunity zone?
A low-income census tract, according to the census data in 2012 to 2016. So Hudson Yards, for example, in Manhattan, is an opportunity zone.
Still to this day, even though it's rebuilt, everything else.
To this day, it's an opportunity zone. It's set in stone, these census tracts. So if you were to, and we can talk more about the nuances and different things of the legislation, but Williamsburg is an opportunity zone. So
and it's overpriced through the roof already. Like no one can even afford to live there now.
Avocado toast on every corner. I mean, is that your visual of an opportunity zone? Not necessarily, right? It's emerging communities. And
so do you feel like, not to cut you off, but do you feel like people submitted facts and data from 2012, they were reviewed in 2017, not understanding that the market's been on a straight upward tear for that time frame, specifically for that 5-year bull run? Now they're like, oh, great, perfect, Williamsburg, opportunity zones is broke. And you're actually like, no, Williamsburg is probably more affluent of a demographic density-wise than Manhattan is when you factor in the homelessness and everything else.
Yeah, no, absolutely. And coming back to the governors, not knowing real estate, I think they really fall into two camps, right? I mean, they're like, okay, these are already Williamsburg. We just want to get more voters. We want to get more support. So we're going to designate that because we can. It's the low income. And then the other tracks are communities that need that government help and that are just completely not with that spark or not seeing the Williamsburg type of, transition, if you will, in terms of real estate prices. And that's where the big concern is gentrification, community displacement.
Sure.
And that's a lot of the things that we talk about as well, with double line, bottom line investing and trying to mitigate community displacement. And how can you have that community be aligned within the opportunity zones and that investments and where everyone wins? I know it sounds like the magic behind the curtain on the Wizard of Oz.
Yeah, but definitely the Oz.
Yeah, for sure.
Let's talk about your background, right? So where'd you grow up? Where'd you go to school? What was your past life? And what was the training, trials, and tribulations that you've personally been through to get you on this big stage of Oz today?
Yeah, so it's been an interesting, career, and then just that progression within that. So I grew up in St. Louis, Missouri, in the Midwest.
Cardinals fan?
You can't get your driver's license unless you're a Cardinals fan.
Or a
So,
Rams fan back in the day.
Yeah, back in the day. Blues obviously is now a bit more prevalent, and that was a long time coming. So that was good, good to see. But so finance and accounting undergrad, third generation contractor, real estate construction. Moved to Manhattan as I became more interested in finance and accounting. Went through the CFA program, Harvard graduate studies in core and real estate. Worked hard at first job out of undergrad, essentially in Manhattan at Moody's Investor Services. So I worked at Seven World Trade, just getting more from a DSCR, debt perspective, on understanding on how credit works. And this was an interesting time in 2008 where credit had a whole new meaning.
Didn't exist.
Yeah. Or it did, and it just wasn't a good
or it's too
term.
expensive.
Yeah.
Yeah.
But worked hard for about a year, got the opportunity to live in Hong Kong, Singapore, London, and Paris, all through Moody's, and just understanding that credit risk and the modules within and how to analyze that. Came back to the States to work for Colonial Consulting, and they managed just at the time about $50 billion in assets.
The B. 50 billion.
With a B, with a B. And it's all foundation.
A lot of people haven't heard that B word before.
Yeah,
billion.
That B,
it's usually million.
B, Oz. There's a lot of different jargons and things. But no, so came back specifically to work with nonprofits and foundations and endowments. And what's interesting about, community foundations is that they can take on more risk than the average investor.
Is it because they have more capital, or they don't have to answer to anybody, really?
I think it's the latter, right? So the liquidity within that, they only have to spend 5%, and then anything above that is gravy. They get to keep it.
Wow.
Right. So
it's a big shift there.
It's a huge shift. So when you don't need the liquidity and you can, let's say, return 15, 20%, that's all coming back to the endowments or nonprofit, and that's how they can have that perpetuity longevity. So you can take on real estate, you can take on illiquid assets, and
almost without losing sleep at night.
5%.
Yeah.
So some have larger missions and things, and that's where I really start to understand like a double bottom line. If you were to give up 2-3% in investing in a social impact cause,
why not?
There's a big why not. So if a Salvation Army or a larger community foundation, not to use any names and any specific missions, but if you were to give up 3-4% in your $500 million endowment, that's almost $50-something million that you could give back to the mission and the people that you directly want to help.
Wow.
So invest in what you want to invest and then use that mission that way. It's a delicate balance where...
Do some people go over that 5%?
Oh, absolutely. Yeah, absolutely. So that's the minimum just to maintain your nonprofit status. But universities, you're starting to see now with climate change and carbon emissions, where students are sitting outside of the investment committees and saying, hey, look, we don't want to invest in fossil fuels. But when you look at the data, if you're to give up millions and millions of dollars, well, that means your tuition is going to go up. Are you okay with that? Or, how do we figure out a positive way? So, not to make this long-winded story, but at Colonial, we focused on positive screens and different creative approaches to think about that hurdle and double bottom line. So I worked with BlackRock and other fund and architects, and was able to create a positive screen for a low carbon index, and it's called CRBN. It's traded on the stock exchange now, so I was actually able to ring. It's
pretty cool.
The closing bell. So
that's a good experience.
It was great. It's trading very well. I mean, it's performing well as well. So it's proving that what has happened in the past, if you were to avoid tobacco, alcohol, you would probably underperform. But moving forward, there's such that shift in mentality and framework and mindset that if you're not thinking from a social lens in everything that you do, is just
absolutely
is a poor.
So now they say usually there's always the 80-20 rule, right? Yeah. For every dollar you make, 20% of it should be going back into the bigger picture. Why are these nonprofits and universities and people only required to do 5%? In your opinion, why is it not 20%? Because 5% means it doesn't even move the needle to a sense where it impacts anybody.
Yeah, so I mean, we were actually literally just having that conversation this morning on how that dollar of donation or how that dollar revenue goes back to the community, and it's tough. It's a business. So you think of nonprofits, it's just like a business. What's the margin on an average business? It depends, but let's say 50%.
Right.
So only
which is high.
which is high.
Yeah.
Right? Absolutely. Right. Absolutely.
People try and get 10%.
Right. Exactly.
Yeah.
Right. So when you're talking about that 5% spending
Sure.
cap, it's you just need to maintain that business. You need to be able to hire and hire the appropriate people. So that's why Colonial had such a prevalent business, is because they took that fiduciary responsibility off of the community foundation's shoulders and said, look, we will invest this for you because we have the background and the knowledge base.
Now, are universities, endowments, all these people now coming to you and saying, hey, I hear you're the expert. I hear you're the Wizard of Oz. Hey, we have $60 million. What do we do with it?
Yeah, so, and that's another fantastic point. And we are starting to see that a lot more, where universities, community foundations are starting to say, look, we may not want to be equity, but we'll be first lien on certain loans just so you can get more favorable financing.
So they'll take loans 4, 5, 6%, no problem, all day, just
all
to
day,
grow their money,
yeah. Or,
rather than keeping it in the bank.
Or have that collateral on our behalf or something along
Yeah,
those
if you
lines.
default, then they get the asset.
Exactly. So then banks will look more favorable and then have that
Wow.
more liquidity. So again, coming back to the double bottom line, not having that social impact, you're telling me that it detracts from returns and not enhances it?
Right.
So we're focused on rent-to-own models where we've trademarked an OZ scorecard. So we're the
That's pretty cool.
yeah. So it's
It's
coming.
kind of like a golf scorecard where like you play by holes, or no?
Yeah. I mean, you can call it a golf score. I'm trying to think of your analogy and continue
Yeah.
on with it. But yeah, so using the front nine or back nine analogy, we have different sort of groupings of what we look for, and it's going to be financial education. So, and I can talk more.
Financial education to the rent-to-own participant.
To anyone in understanding about finance, right? I mean, we were throwing out jargon in terms of
Oz.
I mean, IRRs,
Yeah.
double bottom line, all of the different returns and things that.
Which is way over the level of complexity that your average human brain can deposit.
I mean, it sounds like English.
Right.
But
IRR,
yeah.
they're like, I heard the IRS.
Yeah, right. And I'm pretty sure that's not a
Right,
good thing. So whatever that looks.
Sure.
But yeah, so having that mentality of trying to at least help align the community, and we can talk more about that and how.
Is there resentment coming from anybody though?
In which sense?
Let's say a poor community that's like, oh, you've neglected us for 50 years. Now all of a sudden you want to come in and improve our neighborhoods. Or, for example, you might have local politicians that are like, hey, we don't want this area to prosper because we make our money on X, Y, and Z.
Yeah.
Or maybe if we improve the area, we have to cut our police force. Are you getting any type of negative feedback from people or no?
It's another great question, right? So yes and no, right? When we think of opportunity zones, almost think of like the Olympic model. When you think of the Olympics, sounds great. Everyone loves sports. We can open the podcast with, who do you follow? But if you're investing in sports stadium when, let's say in Rio, there's rioting on the streets because the basic needs have not been met.
At all.
Yeah. And
no food, no water.
taking out more from the community in which you put in is not a something that we focus on, but absolutely is a concern with opportunity zones and having that. Maybe this is a controversial subject. I don't know.
Okay, we like controversy
okay,
here.
All right. Well, so the Olympics, if they, we can edit this out, right?
Yeah,
so,
we need to.
perfect.
But we're not gonna. It's raw. We're going all raw.
All raw.
So I'm wearing my hat. It's wearing my hat for you today. It says raw. Look.
All right.
Raw.
So now we have to do it. Yeah. All right. So running with the Olympic model, not having that, community displacement, not giving up those basic needs, exactly like you were saying on saying, look, we made money this way. You guys have been neglecting us for so long.
Yep.
Of course, right? I mean, that's the concern. And that's where the OZ scorecard that we're trying to say is we're going to hold ourselves accountable, because you almost don't know that it's predatory practice until, for one, it's too late, or you don't know the industry standard as well. So it comes down to communication, awareness, and education.
So do you feel like you guys are actually setting the bar for the rest of the OZ players?
Look, we can say yes and no. We're always looking for other players to see what they're doing, see if we can try to help, see what the industry standard is, because it is a bit of a moving target.
So you're basically making the yellow brick road. That's what you're telling me.
Yeah, exactly.
I would have put the song on, but my phone's locked.
Yeah.
We'll edit it in.
We'll edit it back in. Yeah, absolutely. But no, where you are on the yellow brick road is helpful too, because how do you know where you're going until you know where you are? So having this OZ scorecard, this is where we are today. Mm-hmm. This is where we're going, or this is where we plan to be. Mm-hmm. So one of our big goals is, mitigating community displacement and not having opportunity zones in 10 years' time, just 3 miles outside of where they are today. So that's ultimately what's going to happen in different communities that with the Olympic model taking out more economic benefits than putting in, there's just going to be low income census tracts further outside of the city. It's just going to be pushed out further. I'm not saying we're having the solution or setting the yellow brick road, but we're trying, and we're trying to you really set that accountability.
It sounds like you're like laying the bricks with the proper foundation, or at least based on what you currently understand the rules to be.
Yeah. So within those bricks, we're having financial education, community like awareness, and then a community alignment, which is job creation. So we're
Huge.
going to measure that.
Yeah,
Absolutely.
right. Especially with the downturn coming in the market.
Right. And then having that awareness, and then mental health, and then mental awareness.
Biggest topic ever. Yeah.
Very, very controversial, but extremely important.
Right. People have to have that discussion.
Absolutely. And, I think there's a lot of unknown around those topics as well. They're different languages.
I've become an expert in that over the past 2 years.
Well,
studied it.
We need to follow.
I studied my own body. I know.
Yeah.
Yeah. Recap number 2.
No, it's so true, though. You're studying your own body.
Yeah. And it's only based on experience, right? Like, It's like, oh, this hurts. Why? It's like, what's taken place to cause this pain to hurt? Is this old pain? Is this new pain? Is it muscle pain? Is it mental pain?
Couldn't
and
say
especially
better.
in urban communities or underprivileged communities, I can only imagine how much they're holding on to.
Yeah, you say way better than I do, by the way. So that's exactly it, right? Just understanding where you are and why, like taking a step back.
Well, there's a thing that they call, we're getting way off topic, which is fine. We can do whatever we want. We're raw, right? We're raw and real. So I have a funny story about St. Louis, too. You have to remind me.
Okay.
Super funny. Like, it's going to be really funny, actually. I have to really focus in on it. So fight or flight mode, right? That's what people call it, right? Are you in fight mode or in flight mode? So shoulders forward is fight, shoulders back is flight, right? You figure that out. So they say most people that are underprivileged, have nothing, live in squalor, for example, are constantly in fight mode. So no matter what they see or hear, they're automatically programmed. They've been automatically programmed or triggered to fight, right? So when you go into these communities, you're like, hey, we're here to help you. They're like, no, screw you, because you neglected us for 50 years. And now you're like, no, hey, we're trying to help you. And they don't accept the help because that's what they've been trained to accept.
Yeah. No, I think that's definitely true, and I agree to a statement. I think of Daniel Kahneman had a book called Thinking Fast, Thinking Slow. So, back to your point on it took you this long to figure out your body.
30 years. I started in 2017, so 30 years.
And I'm not criticizing, right?
No, right.
I was just saying.
Truthfully. And I'm semi-educated.
Yeah.
Semi.
But even if you weren't, it's just understanding that what has happened today has been your reactive mode.
Completely.
So when you think of fight, that's your short muscle fibers, if you will, coming back to sports. And those are the triggers. And just understanding there is slower muscle fibers, and that taking a step back and understanding maybe these are my biases.
Right.
So I don't think it's wrong to
subconsciously even.
Yeah, absolutely. I don't think it's wrong for anyone to be completely leery or I get skeptical from money coming in. I would agree with you. Like, right, what has happened in the past, I think what you're saying.
All these rich people are now putting money here because they're getting tax benefits.
Right. So having that trend, why wouldn't that continue, or what's going to change that? And then
awareness and education,
then trust, and it's going to take time. So we're going to measure it over time. We're not the Wizards of Oz, as much as we like to say it, and behind the curtain, but we would like to try to have that we call them minor victories, and then have that double bottom line. So we still have to make money. There's impact investing. We want to make sure that delicate balance, that we're not giving up return either.
Right.
Because again, having that mission, coming back to that initial analogy of, well, we could then just give that back to the community in the way that we wanted to, directly in that way. So making sure it's that prudent investing, it's a good project, having alignment is enhancement of returns and not detracting from it, and that's the key.
One thing, and I learned this at super early, is I get chills. You can see on the camera. My hair is standing up on my arms right now.
It's raw.
It's raw. It's raw and real. The problem that I've always seen with real estate and lending, right? Real estate banking, real estate mortgages, real estate lending, real estate whatever, right? Is somebody gets lucky or makes money in a field, industry, product, program opportunity, and then all the bottom of the barrel, bottom feeders try and come in to chase, oh, well, look, if Josh did it,
Right.
I could do it. I'm smarter than Josh. Or, hey, I have more money than Josh. Or, hey,
FOMO,
I have so much FOMO, right? FOMO, where they hurt the industry, right? And I experienced that firsthand at an early age of 21 in the mortgage business. Luckily, when I got into the mortgage business, everyone was getting out because they were all a bunch of pussies and like really couldn't handle and didn't know how to do the business, right? Truthfully.
Right.
And they were quitters.
But
I get it.
You know, FOMO as well, like saying
Correct.
in the other direction.
Completely.
Yep.
Now, 3 years later, when rates dropped to 3%, all the cowboys that got out of the business, it was too hard, too tough to close a deal where you actually had to work and know the business, got back in, oversaturated the industry, messed up the banking business, opened up mortgage companies with no capital, couldn't fund loans, couldn't sell loans off the warehouse lines, and hurt the general public, in my opinion. Okay?
Yep.
Do you see that as a potential issue for opportunity zones?
Yeah, so, you know,
Because people with money like to throw it around.
absolutely. There's $6.1 trillion of unrealized capital gains in the stock market alone. And,
$6.1 trillion.
and that's what we didn't even mention, right? So opportunity zones, what that means is if an investor were to sell a stock, bond, or business, no matter what it is, if you were to roll that into an opportunity zone fund, it has to be a qualified fund.
Just a fund.
Just a qualified fund, you get that deferral of that initial gain of tax, and we can talk about how there's creative strategies to completely avoid that as well. But then if you were to hold it within that fund or a piece of real estate or business for 10 years, it's exempt from taxes. It's not a deferral. It's not a kick the can. It's
So
an
I'm
exemption.
going to give a crazy example. I'm just going to escalate these levels to much higher than what I did, right? So let's say, which I did, in 2012, I bought Facebook at $17.
Gotcha.
I sold it at 20 because I needed the capital to then put back into my mortgage and real estate business, right? Whatever, it is what it is. I've done that a lot. I've had picked a lot of winners, took little, small 20, 30% trades, which are great trades, right?
All day.
But they should have been long-term holds, but I need the capital for other ventures. Yeah. I buy 1 million shares of Facebook at $17, right? In 2012. Now today, that's worth 10 times more. So now it's worth 170 million, or more than that, because Facebook's almost $200 a share, right? I now have a big tax burden, right? 15, 20, 30%, whatever it is, whatever comes out to. If I sell out of all my Facebook right now, let's just say, again, for argument's sake, my tax burden is $60 million, right? Potentially on paper. Right. I could take all of the profit made, put it into a qualified fund like your own, and never pay tax on it as long as the money sits there for 10 years.
So it's even better, right? So it's a matter of not only can you just take that gain out, the principal you can put in your pocket tax-free. So it's really split. So of that, the principal of the investment, the $17 or whatever.
Yep. 17 million, whatever it is. Yeah.
That's, you can buy a boat. You can do whatever. You can put in, spend it however you want. It's not taxed. Only the gain portion is put into the fund. Does that?
The gain, whatever you made.
Yeah.
Literally every penny you made.
So it's different than a 1031 exchange for real estate investors where you have to invest the entire lump sum and then continue to roll it over and continue to be invested.
But that money's locked up for 120 months, 10 years.
For 10 years, yeah.
Now, can that person still earn interest on that money while it's in the fund? Are they going to be receiving dividends, payouts, whatever?
Right. Absolutely. I mean, it's
tax-free or not tax-free? At this point, they're getting taxed on it?
There's still the tax nuances of real estate within the opportunity zone legislation. So dependent upon how and what you invest in, it's going to be those distributions that can be shielded from taxes dependent upon where your depreciation shield comes in. Do you know what I mean?
I get it. Yeah.
You're going to have a basis, and then that's where they're talking now of, what about cash? Can I invest cash and not even gains into these because it's a good investment? Well, you don't have a basis in cash, not to get into the nuances of the tax law, but 6.1 trillion alone.
It's enough. It's enough to fund America.
Right? 1% of that over 8,700 census tracts.
Forget about it.
It's
a big number.
A big number. Let's say almost 10 million of just 1% of that. You think that's just equity in each census tract. So you put some debt on that. That's 50.
Who are the players right now that you've seen from an investment standpoint coming to the table? Is it big institutional funds? Is it small mom and pop shops? Is it, family offices that have high net worth individuals? Is it your, tech IPO early employee that hit money? What are you seeing from the early stages of, raising capital for your fund? Who's coming in?
There's a lot, right? I mean, and maybe there's just that level, that different level of education, but I would say maybe 200 different types of funds, all different types, just because of that incentive is so strong. So that's almost beginning that wild, wild west, that Wizard of Oz
Sure.
sort of, let's say hurdles, because everyone has their own reason. And, with the path of least resistance is basically electricity, water, and humans. So it's a low hurdle to create a fund, or reasonably low hurdle to create a fund in terms of just getting legal and everything else set up through.
Sure. You can get your sub-docs and you're good, pretty much.
Absolutely. And there's larger funds raising capital. There's smaller funds. There's community-specific funds. It really runs the gamut. And I think we're just making sure that accountability is there. So the OZ
and performance.
Scorecard and performance. And then making sure that, that Olympic model doesn't come to fruition, which is everyone's concerned about. But
now, what's your minimum investment for your fund in particular? Say your average Joe listening to the show has some money, has a retirement, they want to put money in your fund. What's your minimum investment that you have?
Yeah, so we, we're raising $75 million. We have to raise from qualified investors. So that means you have to have a minimum income, net worth, or income coming in with the propensity of continuing that. But the minimum is 250. We're making smaller transactions as of 50K.
For friends, family, associates.
Family, yeah. So a lot of our personal money is invested, friends and family as well. And then just having that alignment. So, there was a couple of folks that have just sent us money to saying because of the mission, and they would have to pay the taxes anyway.
Yeah, regardless. Yeah,
exactly.
Yeah, right.
Yeah. So,
get whacked either way.
Right.
I'd rather lose 40% than pay the government 40%.
What's the risk on paying the government 100%?
Sure. Nothing.
Yeah.
Interesting.
It's 100%.
Talk to me about raising capital. That's a big thing I know people are going to want to hear about, right? So usually, and I've done it for smaller real estate projects, investments, companies, et cetera, on my own, right? Very informal. Like, hey, here's a promissory note. Here's our agreement, right? Yeah. Nothing fund level yet. Maybe one day we'll do that. When the market collapses, we'll have to raise our own hard money fund. But it's coming. Yeah. It's coming. So you start off with your own capital to pre-fund everything, right? Startup costs, everything. Yep. Then you go to friends and family and say, hey, listen, I got this great idea. Friends and family kick in some money. I like you. I trust you. I know you came to your first birthday. Here's some money, right? Or I inherited money. Here's some money. And then you go to the investor institutional pool. Walk me through that timeline, if you will, of from day one, first idea, hey, I'm putting my own capital contribution in, all the way through raising institutional money.
Yeah, and I guess I didn't even finish the rest of my, career and trajectory on how I got here. But after Colonial, I went to Lazard Asset Management and worked with families and family offices and in the high net worth, full discretion across the entire portfolio. So, having contacts within those communities. And then after that, I went to a private equity fund that focused on the Midwest and Southeast, and again, just had those, more and more conversations with institutional or accredited investors. So that was a big time commitment, I guess, throughout my career to have those connections and those relationships above and beyond the friends and family. But yeah, back to your question on raising capital, it is a lot of upfront. There's a lot of understanding what you know, what you don't know, and especially with the legislation. So we were early. I think when we formed our fund, the legislation wasn't completely hashed out yet. But
So your grandfather in, pretty much.
We were grandfathered in, and it's with the IRS rules. We understood the intent of the legislation, I felt, very well. And just to give you an example, even just a year ago, there was no funds. It was just asset specifics because of the nuances of the laws, and not to get into it, but we're like, there's no way that you can just have an asset specific. That's not the intent of the legislation. And then not just that, there wasn't any flexibility upon the asset sale either. So for 10 years, you would have to hold that. We were saying for 10 years, you're talking $6.1 trillion. All of that goes in on year one, and you're telling me I can't sell it for 10 years? What's that going to do to real estate prices in year 10?
Yeah.
It's going to decimate the prices.
Everyone's selling.
If that is necessarily going to stick exactly like that is, we want to be on the front end of that trade. But at the end of the day, there has to be some incorporation of flexibility. So, like I was saying, the last 3 months, they incorporated more nuances in rolling out the flexibility of asset sales. So
have you had to actually change your fund documents based on new laws, regulation, or no?
No. So that's what I was saying. We were teed up
perfectly
precisely for this, because that was one of the outcomes in which we had in terms of the scenario analysis for the fund structure. Worst case scenario, we always felt, so coming back to your question on raising capital, setting expectations, under promising and outperforming is really something that we strive to be, and just making sure, being on time and all of those things on trying to do the things that you say. So having those return expectations with the mindset of having one asset for 10 years, now we're able to not necessarily flip them, but we have the flexibility, which
you can maneuver.
Exactly. So coming back to your Apple example, if the time is right and you're selling it, or if you can incorporate, so, it may have been the best move for you, coming back to your statement on, well, I should have held it. Well, you don't know. It's always easy to go back. But,
right.
I mean,
Looking
that opportunity cost, what did you put that money into? Your business and different things like that.
Sure, I wouldn't be here. I wouldn't be sitting here today if Facebook. Put it like this. If I bought 1,000 shares of Facebook today, or back then, you know what I mean? 17,000, what it is today. Right. It's sitting on 200,000-300,000, whatever it comes out to.
Right, exactly.
Yeah.
So
why open a podcast?
Right. I mean, there you go.
Serious.
But no, so we think about that, and then raising capital is extremely personal. It's something that is taking, back to your point on syndication, and there's a lot of rules that we need to follow. So accreditation is one of them. We've structured where we can openly market.
Oh, you can?
We can.
So you'd be like, hey, call me. My number is 555-5555. Give me
917.
Yeah, whatever.
Yeah,
you can do that.
We can say we're targeting 20 to 30% IRRs.
Wow.
And with an 8% preferred return.
So you're targeting a 20% annual return.
Minimum, yeah.
Wow.
So, and that's a 10-year hold.
Crap.
And that's just based on the fragmentation. We're investing in the Midwest and Southeast. The purchase prices are significantly lower than a Williamsburg or Hudson Yards, the conversations that we had earlier. And when you think of, the recession prices, that they're still, let's say, 3-4 years behind the New Yorks and San Franciscos and, Miami. Yep. So, I think those returns are reasonable. And like I said, I think they're conservative. Now, the big syndication, and that's just, those are the estimates and pro forma, and all of those indicators and disclaimers are there. But so I mean, we can market. We're starting to do that a little bit more, but that's not necessarily our intent. I mean, our intent is making sure that mission and the double bottom line is there. But I mean, it's still a business, and marketing is important. Podcast, and we're hosting events quarterly in some of the communities and where we're investing.
All over the country or in certain areas? Primarily
where we're putting money to work.
Yeah.
Coming back to that alignment of the community, the investor, as well as the actual government and the municipality. Mm-hmm. So if you can have all three of those being on the same side, I think is going to be very powerful, and really not have that Olympic framework where you're not having, building a $500 million stadium when schools are being shut down.
Gotcha. So before we go into anything else, I got to tell you the St. Louis story.
Yeah.
So it was 2014. I just moved to a different bank, mortgage bank, and the CFO was like, "Hey, I got you and these two other guys tickets to see this, great national mortgage coach, speaker speak." I'm like, "Oh, cool, awesome." I'm like, "Where?" He's like, "St. Louis." I'm like, "Oh, cool. When do we leave?" He's like, "Tomorrow." I'm like, "Awesome." I'm like, "When do we come back?" He's like, 24 hours later. He's like, "You're flying in at like 7 o'clock at night." He's like, "You're taking the flight out 7 o'clock the following night." So I'm like, "Well, I'm going to be in St. Louis for 24 hours. And it was at the time, the Rams were still there.
Yeah.
So 2014, they were still there.
Yeah.
Yep.
Yeah.
Right?
Yeah.
I think. Yeah. And I'm like, "All right, well, I'm going Wednesday or Thursday." I'm like, "Well, I can't catch a ball game. I can't catch, I'm basically flying out. Most of the trips I've done for business have literally been 24 hours or less. Like one day I woke up flew to Florida at 6 a.m., flew back at 4 p.m. Just happens that way, in and out. So Bumble, remember Bumble, Tinder also? You don't look like a Bumble or Tinder guy.
No, but I know what it is.
Okay, good. Yeah, most people do.
Yeah.
So Bumble, it was just booming, right?
Yeah.
Buzzing at the
Here
time.
we go.
So I go with my buddy who is 2 years younger than me, and he never really heard of it. He's like, "Yeah, that's kind of stupid." So I'm sitting on the plane. We just land in St. Louis. Now you have to land and wait to go to
Lambert,
wherever. Yeah. So I'm just swiping. I'm like, "Yeah, whatever." I'm in St. Louis. Like, this is just fun. And all of a sudden, my phone goes, "You have a match." I'm like, "Okay, cool." I look at it. It's a St. Louis Rams cheerleader. So I stand up in the middle of the plane and I'm like, "We matched." And my buddy's like, "What the hell are you talking about?" I'm like, "We just matched with a St. Louis Rams cheerleader." He's like, "What the hell are you talking about?" And then we met them for drinks that night and whatever. Yeah. And then we had a conference next day. Not a catfish. But it's just funny, It was like, all right, Bumble works in St. Louis. Yeah. That was my only St. Louis story, but one day I'll probably go back and catch a Cardinals game.
Yeah, no, that's a good start.
You got pretty girls out there.
Yeah, it's not bad.
Interesting.
Yeah.
Oh, very
Yeah.
cool. So back to the
Yeah.
Oz. Okay, back to Oz. Where do you see this being a year from now?
Yeah, so we try to set those goals, like 1 year from now, 5, and then 10. I mean, 1 year, let's fast forward in the sense of, the amount of capital being deployed, I think is around 800 million, or at least being raised right now across of all funds. Back to your question on raising capital. So
Seems like a small number though, 800 million in the scheme of things.
in the grand scheme of
And
things,
16 million per state.
exactly, right?
Yeah.
So when you talk about that 800 million, the regulations came out about 3 months ago, and that really clarified a lot of things. We're talking about real estate, but they're businesses that we really think will have that transformative change. So the low-hanging fruit is very much the real estate. The legislation, the law is very clear cut, but you can invest in a business in an opportunity zone and still get that benefit.
Wow.
So if a Apple, a Google were to be domiciled in an OZ, having that capital gain or having no taxes, they would have saved billions of dollars.
So you could almost set up like a financial education service center
Yeah.
inside of the opportunity zone and fully fund it and invest it and then run with it.
Right, absolutely. Or tech startups.
So have you potentially
incubators.
thought about putting together like not only opportunity zones, the real estate portion of it, but also ancillary businesses that would benefit from it, that would obviously have to grow inside of that?
Absolutely.
Medical centers, you name it.
Yeah, no, I mean, they're just complementary, right? So coming back to St. Louis, where there's a ton of pretty women and there's the Cardinals and all of the things that way, but the Cortex district was there, and that's where there's 2 hotels that
I stay at the Drury Hotel.
Yeah, that's not bad.
Yeah, there's
It's downtown.
Yeah.
But you're there.
My
for
chief
24
CFO
hours.
booked it, so he wasn't going to
Yeah.
put us anywhere,
Yeah.
high end.
Next
They're like,
time
oh,
we
that's
go,
good.
Yeah,
Yeah.
we'll get you set
Well,
up
there's
somewhere else.
apparently a lot of Drury hotels,
Yeah,
supposedly, so we went to the wrong one initially. Like, yeah, we're at
Yeah.
the Drury Hotel. The cab took us to the wrong one, so
yeah.
whatever.
Well, next time, next time. But maybe converting a brewery to a better hotel could be a strategy as well.
Interesting.
But focusing.
Well, that's the space that you're in, right? You're in that hotel space.
Absolutely. So and we can talk about you have to improve the basis, and this is how it has to meet the regulations. But investing in a tech startup could be
Huge.
transformative. So incorporating technology, education, science in certain areas, which coming back to the fight versus flight, and understanding that there's imagining a better alternative is another thing that we
Right.
say, but investing in some of those, businesses, I think would be very transformative in that, that's the strategy we're looking for. So real estate is very much the forefront, and that's where, if we can do that correctly, kicks off a lot of cash, and that can just be redistributed in that way. But that is very much the double bottom line strategy, to invest in real estate and then coming back to those financial education and businesses.
Interesting. So as we wrap up the show, we usually leave everybody, to listen to something that they could implement in their daily life or deposit that to their brain, if you will. What's one thing you want to give from your 30 years of experience, plus or minus, give or take, right, on this earth, that you want them to walk away with?
One thing?
It could be anything: personal, business, strategy,
Besides wearing a
motto.
raw hat.
Yeah. Yeah, exactly. Definitely gotta get a raw hat.
Yeah, no, I don't. It's a tough one. Only one thing, I guess, when we talk about on just what we're doing and how the impact we're having is that really just kind of focusing on being aware of kind of like you're saying, if you were to know more about yourself and understand on how your body changes, I think that's helpful. So asking questions and being afraid, and not afraid, rather, to ask questions why. So coming back to example, fight versus flight, asking that and understanding and really just, being comfortable with trying to understand the other person's perspective as well, or whatever that is happening.
Sure.
So I think that's extremely important, and just being a bit bigger than yourself is that's something that people tell me, but I've never really heard of, and I'm always just trying to do. And really just everyone has that story, and
Yep.
and not that anyone's is better or worse. It's just trying to understand and break that communication barrier down.
Interesting. Awesome. So I really appreciate you coming
Yeah.
out to the show, being our guest,
Thanks for having
educating people on Oz, and hopefully we look forward to having you back on the show for a recap, maybe a couple months out when you grow, and you can walk people through the transaction and your process down the line.
It sounds great.
Thanks for coming in. Appreciate it.
Thanks for having me.